Richard, thank you very much for being here. You are the Global Chief Economist for CBRE, and you have a lot of data in your hands. And when you look at emerging markets, what countries do you believe offer the best opportunities for foreign investors?
Well, the one that's front of mind for me, and maybe it's because even though I'm English, I actually live in Dallas, Texas. So the one that's front of mind for me is Mexico, where, we see the benefits of reshoring of manufacturing, and a lot of industrial activity in the north of Texas, and goods coming through that port of entry, flowing up through what we call the NAFTA superhighway. But that looks like a growth story. And I've spiked out Mexico, but I think it's probably that nearshoring of activity is likely to spread beyond Mexico. But front of mind, I would say Mexico. But also, when I look at the economic data, India is another market that really seems to be taking over from China. Not in terms of its overall economic significance, but the level of sustained growth that it's going to achieve. China has got good growth, but it's bogged down, I think, nowadays by its housing market, which is going to take many years to correct. So Mexico and India are the countries that are front in mind. But the emerging markets have higher growth rates than the developed markets. So there are lots of opportunities in emerging markets for the people who really know how to operate there.
Perfect. Not long ago, everybody were betting that interest rates would be going down by now. Not maybe to the same level, but start going down now, and that would help capital to flow to emerging markets. Well, as we have seen so far, not much change in that front, and we don't know if it's going to change or not. How that is impacting the investments, the foreign investors, in terms of deploying capital in emerging economies?
Well, I don't think it's just, overseas investors. It's affecting domestic investors in the developed markets as well. It's a remarkable situation in some ways that we've had the sharpest rise in interest rates in 40 years, but we've still got very robust growth. And that very robust growth, particularly in the States, has kept inflation higher for longer. So only now are we getting through the inflation surge, and we do see interest rates coming down from this point, but not very quickly. They're going to drift down slowly, maybe 2 cuts in the Fed funds rate this year, 3 cuts next year, 2 or 3 cuts the year after, with a 10-year Treasury finishing this year at 4.1%, maybe 3.6, 3.7% next year. So interest rates are coming down, and that should start to ease capital markets conditions. Spreads have already come in, so markets are looking forward, but at the moment, there aren't many investment transactions taking place. Our house view is that there will be a pickup in the second half, probably Q4, in investment transactions. So that's domestic and cross-border capital.
Are you concerned when it comes to the the USA market, the office market here in the US? Are you concerned about the future of the market? Or do you believe that as soon as the interest rates start going down, there will be a natural adjustment and we will be facing a soft landing in the commercial real estate as well?
We have a soft landing for fundamentals outside of the office sector. So net absorption is more or less held up in the major categories of retail, industrial, multifamily, data centers is extraordinarily strong. It's a bit weaker in the office sector. We had 6 or 7 quarters of negative net absorption in the States. But by and large, in the United States and globally, real estate fundamentals are pretty sound. I wouldn't say there's been a hard landing for capital values, but we've probably seen 20 to 30% value loss. And values are still falling in real estate capital markets. Now, if you've got a long-term perspective, if you're an owner and you've got a long-term perspective and you know that there'll be value recovery, then I don't think that matters. It's causing a problem in the United States. There are $2 trillion of loans over the next 3 years that need to be refinanced. So there is a degree of tension around what's going to happen when those loans come up for refinancing. At the moment, the loans are being extended. Because the real estate is still income producing and can pay off the loans, people are ignoring the capital value drop.
I see.
At some point, investors and banks will have to realize and crystallize some losses.
Hey, what about Europe? We always talking to our members in Europe, and a lot of them say that they need to take care of their own house before thinking about looking for new opportunities. Is it similar to the US, the market there? Do you see any difference in terms of what comes next?
I would say it is similar story, but I think in Europe they have more strict planning regulations. So I don't think we've got, although there's elevated vacancy, I don't think there's an oversupply of real estate. We've got quite elevated supply in US real estate, in multi and industrial. I don't think it's quite as extreme in Europe. And I don't think the banks are quite as much exposed as the American banks. But economic growth has been weaker. So I think in Europe, growth hasn't been nearly as robust as the United States.
That's true.
That will come back, I think, over the next 18 months. Europe is picking up quite nicely. So I would expect to see cross-border capital, maybe not this year, but next year, flowing out of Europe.
A final question. When you look at all the data and you probably factor some geopolitical analysis as well inside of your numbers, is there anything that would keep you up at night?
Yeah, I mean, always. I mean, I think the economic environment is, looking at a soft landing. It's surprisingly good given the shock of interest rates. But clearly, we've got two hot wars. We've got, the Ukrainian war, we've got the Middle East war, and, those create unpredictability. I would be a little bit worried about, the impact of more aggressive action by China against Taiwan. So that could really create a difficult situation. I think it looks like the United States and China are working very hard to manage that tension, because it's in nobody's interest. China and America, they depend on each other economically. But it is one of the things that I worry about.